Okay, welcome to the Personal Finance Unit number 5, the Fundamentals of Investment presentation lecture. This presentation lecture will be part 1. We will get through part of the material and then we will pick it up with part 2 to finish up the remainder of the material. So let's go ahead and get started. All right, so investments. When it comes to investments, what are they exactly? They are assets purchased with the goal of providing additional income from the asset itself, but with a risk of loss. Investments are going to assume a little bit more risk than, say, a savings plan. However, the savings plan and investments are going to make up your individual financial plan. Now, when it comes to different investments, all investments are going to assume some risk. So when it comes to the risk that's assumed, let's first take a look at what type of return we'd be looking for in our investments. In order to earn a return, that is going to be profit or income generated by the saving and the investing process itself. Now, the trade-off here is the higher the return, normally the higher the assumption of risk. Investment risk is the possibility that an investment will fail to pay the expected return. Investments have the potential for higher returns than a savings account or, say, a saving investing plan, but however, the risk is the trade-off in between those two different savings plans. So if we take a look at a savings tool, which is also considered a monetary asset, these are very liquid and they can quickly be converted to cash. If you go to the bank and you make a withdrawal from your savings account or transfer savings money to your checking account, it automatically becomes cash to you. Investment tools, which is also investment assets, not necessarily the same. So these cannot be easily converted into cash, and if they are able to be converted to cash, normally the investor is going to be charged some type of a penalty. So investments, even though they are less liquid than savings tool, also are going to offer a higher rate of return. Now, investments can help accomplish those long-term goals. Money invested is usually used to pay for long-term goals. So when we pay for our long-term goals, whatever they might be, could be examples such as buying a house, higher education, or retirement, we might be investing in order to be able to fund those goals. Now, it is recommended that at least 10% of your net income is dedicated to a savings and or investment each time income is received. Now that's an average. Don't stick to that, but try to get to that. Some months might be 5%, other months might be 15%, but in the long term, you want to average about 10%. It is a basic rule of thumb for saving. Now, if we take saving and investing and we compare the two, saving is normally used for emergencies. It is a more liquid type of tool. There is limited risk, not nearly as high of risk. The return rate, however, is much lower, only 0 to 4%, and it can help provide some financial security. Now, on the other hand, investing, normally used for long-term goals, less liquid than a saving tool, a lot higher risk, which is also going to be a higher rate of return of 8 to 12% normally, and it is going to help increase your net worth. So what types of feelings result from saving and investing? Think about that for a second. Feel free to pause the presentation lecture. And then once you have an answer to that question, go ahead and restart and we'll move on with the remainder of the material. So the rate of return, this is what we're looking for. When it comes to potential investments, we are going to value an investment as a good investment for us based off of the rate of return. The rate of return is the total return divided by the amount of money invested in order to get the rate. Now, the rate of return, the higher the rate of return, the better for us. So let's take a look and put this into action. What is Mandy's rate of return? Mandy has saved $2,200 in a money market deposit account. After 1 year, she has a return of $110. What is Mandy's rate of return? Well, if we take that 110, divide it by 2,200, which is the principal investment, we're going to get 0.05 or 5%. So Mandy's rate of return on her investment is 5%. Now, when it comes to inflation, which is another economic indicator that we have to be aware of when investing, this is the rise in the general level of prices. Now, inflation risk is also assumed by investors because this is the danger that money won't be worth as much in the future as it is today. We know this is going to happen. So knowing this risk, how do we counteract it in our investment strategy? Strive to have a rate of return on investments be higher than the rate of inflation. So if the rate of inflation is somewhere between 4 to 5%, obviously you're going to want to have an investment portfolio with a rate of return of higher than that. So how does inflation relate to investing? So feel free to go ahead and pause the presentation lecture. Think about that for a second and think if you can put it into terms how inflation and investing are going to impact each other and how it's going to impact the investor in putting together a solid investment plan. Now, different types of investment tools, these are some that are out there. Think about this for a second. What do you already know about each of these investment tools? What do you know about a bond? What do you know about speculative investments? What do you know about stocks, mutual funds, real estate, index funds? And there's a very good possibility that you have not heard of any of these yet, therefore you have no knowledge of them. And that's fine. That's the purpose of us going through this unit. But there might be some of these investment tools that you do have some background on. So think about that as we proceed through the rest of the material and as you continue to take notes on what investing is and also as well as investment tools. Let's take a look first at a bond. Now, a bond is an investment tool that is normally going to be considered very, very low risk. The definition of a bond is a form of lending to a company or the government. The description is it's an organization pays interest to the lender, which is the purchaser, until a maturity date is reached, which means that is the maturity date is the date that it can no longer appreciate in value anymore. The investment risk, least amount typically. However, because of its least amount of risk, it's also going to have a lower rate of return. It's going to depend on the type of bond as to what type of risk is going to be assumed, and the return rate is fixed. It does not fluctuate. So when you commit to investing in a bond with a 5% return, that is all that you're going to get. It is not going to change. Now, going back to the description, the maturity date, which is a specified time in the future when the principal amount of the bond is repaid to the bondholder, which means at that point, it's no longer going to appreciate in value or increase its value anymore. Stocks. Stock is a higher risk. This is a share of ownership in a company. Anybody who purchases a stock, an investor who purchases stock, is going to be partial owner. A stockholder or a shareholder are the owners of the stock. These individuals now can go to shareholders' meetings. They can vote on different policies and procedures that are up for vote. However, you are usually the owner of a small portion of the company along with many other owners. This is an example of how big corporations disperse their risk amongst owners. Usually a stockholder pays for only a very small part of the company, the limited amount of shares that is purchased. Now, stock returns and dividends. Dividends, the share of profits distributed in cash to stockholders. Stockholder may or may not receive dividends. So one of the ways a stock can return to an investor is an interest dividend. Not all stocks are going to pay dividends. Not all stocks are going to consistently pay dividends. A lot of that depends upon the success of the organization that the investor is investing in. Now, this is not the only way for stockholders to make returns on their investment. They can also do this by a capital gain. Now, market price is the current price a buyer is willing to pay. So if a purchased stock is purchased at $20 a share, if that price of that share is going to increase over time and the stockholder sells, there's the capital gain. Buys it for 20, sells it for 22, $2 return per share that is sold. Capital gain is unearned income received from the sale of an asset. A stockholder will lose money if the stock price falls below what the stock was purchased for originally. So capital gains. Now, when it comes to real estate, this is the ownership of residential or commercial property or land. There is potential for returns, but that potential for returns is going to be through capital gains. This is the selling the property for more than it was purchased for, or the property can be rented, which is charging others to use the property. Real estate can be a good investment. However, you need to understand that real estate can be time consuming, but the potential for the returns can be very high, especially if it's a strong market. Speculative investments, these are high risk investments. They have the potential for significant fluctuation in return over a short period of time. Futures, options, and collectibles, these are examples of high risk investments, also classified as speculative investments. The interesting intrigue about these types of investments is the type of return is very, very high. However, with that high rate of return potential also is a high rate of risk potential. So even though you might have a high rate of return possibility, you also have a high rate of loss possibility as well. Mutual funds is a safer type of investment when a company combines the funds of many different investors and then invests that money in a diversified portfolio of stocks and or bonds. So in a mutual fund could be any combination of bonds, stocks, real estate, or even speculative investments. The types of returns on those investments are going to be interest, dividends, rents, and even capital gains. So as you can see, there's a mixture of these different types of investments, which is going to help disperse the risk. Now, when it comes to mutual funds, advantages of mutual funds is that it reduces the investment risk. It saves the investors time. A disadvantage is that the fees may be high, but you can still see the advantages are slightly outweighing the disadvantages. Mutual funds is a very sound investment strategy, especially for long-term investing. Let's take a look at Ariana, who has a couple of different options here. Let's say that she's got $150 to invest and she's going to choose to do it in stocks. So she says that if I put $150 into one company's stock, which is company C, then company C has a bad year and their market price drops significantly, Ariana could lose all $150 of her investment. That's a lot of risk to assume in a stock purchase. Let's take a look at another option. Let's say that Ariana wants to invest in a mutual fund. So now, if she does this and company C all of a sudden has, let's say company C and company F have decreased values in their stock price or in their value. But the market price has increased for all the other companies. Ariana now has reduced her investment risk, and still may be able to get a return, a positive return on her investment by dispersing that risk. We'll stop right there. That'll conclude the Fundamentals of Investing Part 1 presentation lecture. So make sure that you go back and revisit the slides if need be in order to get the notes up to this point. And then I will see you back here for Fundamentals of Investing Part 2 presentation lecture.